Ladies and gentlemen of the crypto space, we're live on a Friday, June 9th at 11:55 a.m. And we are being protectored. What an image. I mean, he is terminating U.S. domestic crypto enterprise. It's probably not him. His statements are probably a manifestation of the aggregate opinion of the agency. I doubt it can't just be just him. So this is coming from either a stronger force that is requesting this particular behavior. I don't necessarily think it's coming from the average sentiment in Congress. Congress has been quite outspoken and not necessarily in agreement with the amount of pressure that the SEC has been placing on domestic crypto enterprise, traditional enterprise, brick and mortar, employees, lawyers, so on and so forth, traditional enterprise. And that's not necessarily the equation we consider, nor is U.S. domestic enterprise a market which we necessarily allocate capital to. It's so imperative to be able to distinguish between a company, a traditionally structured company with regard to employees and human resources and actual offices and an EIN number and tax reporting and all the shit that goes along with a traditional enterprise and something that is not a traditional enterprise, which ultimately is just software, which has a global presence, which is accessible from 195 countries around the world. Perspective and scope is the only way to get a sense of where the hell you are in this big grand scheme of things. Well, what is the system of interest? Where are you actually allocating capital to? If you are investing in the primary assets that we discuss, you're not investing in America. And that's okay. The best opportunities on the planet are not necessarily investing in America. I'll pop it over to the main screen. I'm looking at NASDAQ. Now, obviously, the majority of the planet does not allocate capital the way we allocate capital. They crowd into the most crowded trade on the planet, which is NASDAQ, which is an ETF, which is one fucking security, an ETF. And this is where all this capital goes to. This is mass psychosis. This is the behavior we see with regard to meme coins and the frenzy and the rocket ship vertical up because it just keeps coming in. And it's like people are allocating capital and they're not even looking at technicals. The vast majority of people that allocate capital to this chart look at the technicals. This is technically disgusting. So they allocate capital because of herd mentality. They allocate capital because where else you can allocate capital to? The United States, from a traditional enterprise, a traditional capital market structure, is the primary place to allocate capital. It makes sense to a degree why there's such concentration like this. If you're the cleanest, dirty shirt on the planet, as Brent talks about, this is where you allocate capital to. If everything else is doing worse, and the U.S. is doing pretty bad, you're going to allocate to the U.S. because it's outperforming. Outperformance occurs to the downside as well. Now, I'm not too interested in being part of a crowded trade. I'm not too interested in the structure of traditional enterprise with regard to human involvement. I don't find that enticing from an investment standpoint anymore. I've spoken recently on Twitter about my experiences with banks, regional banks in this instance, but that's generally my sentiment that has become quite strong over the last couple of years. I'm tired of humans. I'm tired of the risk of human subjectivity, my opinion. And the only way to alleviate that is to pursue removing subjectivity from the equation. Now, obviously, you're not going to get 100% relief of the human condition. Bitcoin is probably as close as you get to that. But if a nation state wanted to nationalize all the mining equipment in a country, it's completely attackable. So you cannot eliminate the human condition. All you could do is structure your portfolio, and your portfolio is an expression of how you perceive the systems in which you engage: politics, economics, family, so on and so forth. It's an expression, and you structure the portfolio accordingly relative to these risks that you are evaluating, and relative to the endless list of risks that I have talked about and will continue to talk about in traditional enterprise land. I can't stomach this shit. I just can't. I don't trust humans. Humans will serve their own best interest first and then be philanthropic. Can I get that word out? And that's just that's humanity. It's like what Ayn Rand talked about with regard to the virtue of selfishness. Inherently, she argued that even being virtuous and giving is a selfish thing. You're doing it for the satisfaction or to give yourself validation, like I am being a good person by giving, but ultimately that in itself is a selfish act for oneself. So the human condition is ultimately inescapable, even with immutable contracts, to be objective about the risk profiles that we must be cognizant of. Humans created the contracts, and even though they are immutable afterwards, there was a human hand in its manifestation. So, there are always risks to consider, and then we address those risks with position sizing, diversification, hedging, so on and so forth. And overall, the result of all those behaviors is a portfolio and its associated composition. If one thing doesn't do so well, there's other things. There's always, what does the architect say? There's always a level of survival that we're willing to accept, and that is something you do with like a physical gold or physical silver, or whatever, what have you. Covering worst case scenario is how you find comfort with evaluating all of these conditions of the current circumstance. And that, as I have talked about most recently, is the most important thing, is being comfortable with conditions and assessing the likelihood of paths. And if you're comfortable with the conditions, the paths play out. And we know really where the destination of the path is. We don't know what will occur between now and then. We know the destination. There's going to be a shitload of volatility between now and then. And the only way we could be comfortable with that volatility is understanding why those conditions are manifesting to get us to the destination that the path is indicating is pretty much mathematically inevitable. 22 people in the stream, 4 likes. Hit that thumbs up button. I appreciate all of you. It's good stuff. Welcome, welcome. Dan's in the house. Gazik, Tap, C. Quick question. What do you think could disrupt curve place in DeFi, a protocol far more sophisticated users who would benefit from fine-tuning primitives? Well, you're probably thinking of like the conversation of Maverick and liquidity. And from an AMM capital efficiency standpoint, that is part of the equation. Also part of the equation is the currency recycling regime and the federation that has built around it. And there's literally 3 new protocols that haven't launched yet that are doing the same thing that Conex's doing and Convex has done. And they're going to be accumulating and draining, sterilizing circulating supply of excess CRV currency units. So that is significantly a factor to consider. With regard to disruption, we haven't even achieved global exposure. There's basically zero capital in crypto markets. That's the only way to interpret the size and scale of these markets. It's basically zero. That's Bitcoin included. The amount of currency units, the amount of liquidity in global circulating supply just makes crypto just test and prod at this point. We barely have a foreshadow. This is like the last 14 years is just the initial foreshadow of path. Maybe that puts things into perspective. It's just a hint of where things are heading. This isn't a market. This is testing where the potential market may be. And frankly, all things point to very interesting things. Capital inflow has predominantly been from the US and Asia, but there's a whole world out there of 195 countries. What if even a smaller country, very directly aligns with the capacity for these systems to print dollar liabilities, that could change everything. It doesn't have to be a major nation. If $100 billion worth of capital flows into DeFi markets to print dollar liabilities because there's maybe a dollar FX shortage, that changes the equation significantly. There's only almost $70 billion worth of liquidity on Ethereum mainnet. I don't give a shit about TVL. TVL means absolutely nothing. This game is scored in dollars, and we measure these systems as an emerging market and the amount of dollar liabilities that have been captured in one form or another. And in that regard, Ethereum mainnet is the primary market to consider. Everything else is basically marginal at best. A fraction of the size of Ethereum mainnet. And I don't really know how to assess Tron, but that's another story. But anything other than Ethereum mainnet is, what, 5% of the size with regard to liquidity? So we don't even have a sense of where the Alt L1s and the Alt L2s are going from. We know they're going from a technological perspective, but with regard to a capital flow and a capacity to attract and retain dollar liabilities, that's another story. But we see what's happened with regard to Ethereum mainnet and its capacity to be sticky with dollar liabilities since late 2019. Got to remember that this 14 years, when you talk about like the inception of Bitcoin, it's only late 2019 that we really started to see what the hell was going on with stablecoins. In 16 and 17, when USDC came onto the scene and the concept of stablecoins came onto the scene, it was really far out. Or like, what the hell is the point of a dollar in crypto markets? Because everything back then was very much denominate your portfolio in Bitcoin, measure in Bitcoin, more Bitcoin, stuff like that. And that all changed really in late 2019 as what started in 2017-ish started to come into the picture. Where you had capital inflow, and I started defining things as an emerging market, and capital flowed in, and capital has been sticky. It hasn't all flown out, and that is a very, very different market as compared to 16 and 17, which was entirely centralized exchanges. That was entirely, if you sold an asset, you have cash on an exchange, what the hell are you going to do with the asset? What the hell are you going to do with the cash? The only thing you do with the cash is buy depreciating assets, so the cash flowed out. And that's not an emerging market, a centralized exchange. That's a business, an enterprise, a deposit in a business and an enterprise. But when you're talking about stable coins on like mainnet, you're talking about cash that's sticking to a market that is accessible from anywhere on the planet. And that is a completely different equation. So post 2020 is completely new. It's different this time in that regard, unquestionably. And we measure the relative strength of a market, and I'm not just talking about a crypto market, relative strength of a market and the amount of dollar currency units that are available, whether you have a trade deficit or a surplus, whether you have excess capital to place in reserves, if you're putting dollars in reserve or U.S. sovereign bonds in reserve. We talk about the reserves of countries. It's a little different on Ethereum mainnet because we don't have a central bank that is accumulating these assets. Basically, what we have is every actor producing an aggregate state for the market. There's a tremendous amount of reserves on Ethereum mainnet. That's the amount of stable coins that exist. That's a reserve. It's capital that was sticky, and that is a completely different equation that existed in most previous cycles, especially ending in 17, and 18 was coming down, and then 19 was just boring as all hell, and that's where we are. That's very much recent history, all history rhymes, it doesn't repeat, but more so post '08, it really rhymes and it kind of repeats as per the liquidity cycle that has manifested. And the liquidity cycle is purely a manifestation of a sovereign, in this instance the U.S., actually having a capacity to service its debt obligations and maintaining a decent amount of tax revenue to finance fiscal, basically establish fiscal expectations or financing expectations. So, that's obviously a digression, Gazika, but I hope that helps. One curious view. Peace. Frank, live on Friday, nothing better. Get some good perspective on the markets. Let me reset YouTube. It seems to have disconnected. Give me 2 seconds. There we go. Noah, you've been working out. My girlfriend said you look slimmer. I fluctuate horribly. I go through my keto phase, and I try my best. It's not easy to be healthy, but I'm not going to digress too much into health. I like keto. It does well for my blood pressure, and it'll keep me alive for longer than if I didn't eat healthy, and that's good for me, my family, and it's good for everyone that I have a potential to help. Rupert, hey, happy Friday. 23 people in the stream, 7 likes. Hit that thumbs up button. I appreciate it. DXY is important. And I don't know how many folks, we see social media topics about it, but I want to remind folks that the liquidity cycle that has emerged since post '08, if you're going to hedge against a drain in liquidity, the DXY is probably the easiest thing to own to account for a hedge against the drain in liquidity. If you have a drain in liquidity, you're pretty much talking dollar denominated. You have less available currency units, and that is going to be price appreciative on dollar FX. It does get complicated, as I've talked about, with regard to the yield on sovereign debt. As the yield goes up, the price point on sovereign debt goes up, and that basically is a decrease in price of collateral, and that collateral has a capacity to print dollar liabilities outside of the U.S. So that is an interesting counterbalance that maybe introduces complexities in just DXY is a way to hedge against decreasing liquidity conditions. But that's the whole point of being structured with regard to portfolio composition. If DXY has a capacity to likely be a hedge against decreasing liquidity conditions, it deserves a consideration as a portfolio component. And I just wanted to remind folks of that. But generally speaking, as this comes down, you have a significant increase in liquidity conditions outside of the U.S. as it is cheaper to buy dollars. Therefore, it is cheaper to finance all corporate capex requirements and sovereign capex requirements, and foreign currency units have more buying power, and that generally makes sense to be an increase in international liquidity conditions. So this is just a wonderful chart. While it's obviously specific to particular currency pairs, and you can get granular with very specific FX pairs against the dollar. But generally speaking, this gives us a sense of the directionality of international liquidity conditions. Go figure. And you can obviously inspect foreign central bank balance sheets, the G4, G5, the top 4 or 5 central bank balance sheets, as well as top 4, top 5 M2 conditions. And then you could consider the global liquidity conditions, and all of that hopefully gives a sense of where things are heading. Me, this chart screams over the next 2, 3, 4, 5 years, continuation to the downside. This is a 6-month chart on the DXY. The second the market sniffs out a breach of that TWAP to the downside, you'll have a significant change in international behavior responding to the expectation that international liquidity conditions will remain favorable for a period of time. You breach that 100 mark, and the markets will change behavior significantly. Now, this is a 6-month chart, so this could take 1-2 years to play out. So I would say 2025 is going to be a very interesting year with regard to assessing where we are from a U.S. dollar global liquidity perspective. And I very much look forward to seeing the next 1, 2, 3 candles on this chart, and that'll bring us into Q1 2025. We have the second half of this year and then two more candles for 2024. So that's it. The three candles in a year and a half. The 6-month chart is a very interesting perspective, and this average on this chart is even more interesting. People get caught way too much in the noise of short-term. What the hell can you do about this? What can you do with this chart? You could obviously trade and assess short-term sentiment and short-term politics and geopolitics, but that's not structural. The only way to inspect structure is to really zoom TF the fuck out. And this 6-month chart of the DXY really helps me do that. Move is another one to zoom out on from the monthly. Um, you know, Treasury is going to do their capital raise. It's a capital raise. Might as well call it a capital raise. Treasury bill issuance, refill the TGA. It's a capital raise, just as a corporation would issue bonds. This is just a government corporation. So they're about to flood the market with these hundreds of billions of dollars of securities. And that is going to increase liquidity conditions, which should logically drive down volatility. As you drive down volatility, as Mike Howell talks about, you increase balance sheet capacity. There's less risk associated with using these collateral instruments to increase liquidity availability. What does that mean? That basically means leverage. That basically means use these collateral instruments to print dollar liabilities, especially from an international perspective, using the historic euro-dollar banking system. And that, that could bring us into the crypto narrative that keeps me quite comfortable, even assessing these complicated current events and short-term difficulties and risk considerations. The path, the directionality is very clear. The directionality on this chart is quite clear. Barring something systemic like something breaking, the directionality of this chart, the last years worth of candles up here. This is a topping pattern. It's a very big topping pattern. You can't get past this line, and it's tried for a year. So the volatility probably should cycle down. The world, everything extends from biological phenomena. Therefore, everything operates cyclically. And cyclically, what comes up, comes down. What goes down, comes up. It's the nature of all systems. Different story with regard to stuff like this, to equity markets. But if we're looking at a volatility indicator, volatility goes up, it comes down. This is the perfect type of thing that is quite cyclical. Volatility. And I mean, currency pairs just literally have cyclicality written all over it. And this chart is basically a manifestation of capital flow. Capital, not currency flow. Capital flow, which is value in a sense, to and from countries around the world. Value, and think of it just, it's flowing. I can't really depict the visual with a hand gesture that well, but the value is flowing all around the world constantly as underperformance seeks outperformance, and that occurs cyclically. So that's quite fascinating. Bond volatility, cyclicality, currency pair volatility, cyclicality, liquidity, cyclicality. Here's domestic U.S. liquidity conditions. It's not really cyclicality because we never have a real return to mean because of increasing debt servicing expenditures every time the Treasury has to do a capital raise. But you find there's a bottom, and this is a heck of a bottoming potentiality. Look at that bottoming. And of course, yep, there we go. It's suggestive that liquidity conditions probably are not going to get much below that. It tried to, and from an average standpoint, this has been trending upwards significantly since 2020. I mean, it's only 3 years, but this chart didn't exist pre-08. There was no Fed balance sheet to this degree. or the Fed balance sheet was not used like this, but now it's used basically to soak up excess liquidity or add excess liquidity to the system, depending on overall systemic liquidity conditions that are dependent on that liquidity to remain solvent. The whole point of government, the whole point of this Fed balance sheet is to maintain solvency, to maintain the existence of civil society. And to do that, they manage monetary policy. They manage now liquidity conditions. Liquidity is now a managed system. It's unspoken, but quantitatively that is what's occurring. It's a managed liquidity environment, a managed liquidity financial system. It's a managed liquidity market. And that liquidity has cyclicality. There's been perfect cyclicality with the ISM and stuff like that. Business purchasing demand, and as the demand just falls off a cliff, and those are precursors to like GDP falling off a cliff. That's not going to allow tax receipts to finance debt servicing obligations and allow nation states to remain solvent. So they have to modify liquidity conditions such that productivity increases and tax receipts increase such that they could keep the balance sheet balanced. 27 people, I appreciate all of you. FBTC is something that I always keep an eye on. The old narrative of which is more significant, the decentralized system that's going to replace the traditional financial system. And when the world burns, the persons that have Bitcoin are going to be the lone survivors with capital that is actually meaningful. And only if you have Bitcoin will you survive the financial apocalypse with value retained. And bear in mind, that narrative in particular has a different perspective depending on the country you're in. If you're in Turkey, clearly Bitcoin has been continuously outperforming, but the dollar may have been a more superior allocation. If you could acquire dollars, it may actually be easier to acquire Bitcoin in Turkey as compared to dollars. That's another story, and it introduces significant complexity into the balance sheet, the portfolio management of individuals in such countries. Access to varying assets and currency units introduces a premium, risk premium. If you can't liquidate, that's a risk premium. And then it increases the complexity of managing one's capital. But I find this chart quite interesting, and it's quite suggestive from a technical perspective, which has been outperforming, and it is clearly, since 2016, Ethereum has been significantly outperforming Bitcoin as a capital allocation. That doesn't mean much conclusively with regard to portfolio composition. It's just quite suggestive with regard to maybe position sizing, potential for inclusion. You have to consider potential outperformance, and there's a lot of potential opportunity costs associated with this type of asset being a portfolio component. Those are major considerations. USM2 chart is slow, only have the monthly, so basically we check back next month and we'll see where M2 is. But generally speaking, global M2 has been up, only up. It doesn't go down. Thank you, Japan. Thank you, China. So they're financing the capacity for the United States to drain domestic liquidity conditions, which in turn allows the United States to have some sort of control over domestic CPI conditions, consumer price inflation. So as the world inflates the currency supply, the U.S. is able to deflate its currency supply to hopefully provide some disinflationary pressure to consumer price inflation. Always a reminder, the distinction between consumer price inflation and currency inflation is very real. There is quite a different significance entirely. Inflation is not just inflation. Never forget that. Critical to understand and appreciate. Bitcoin holding the 200 SMA on the weekly. 2 days left. Obviously Sunday evening. That'll be quite interesting because that's the candle we're on right now. If we see a push above, close to 27, a nice thrust back up to the TWAP. It's still below the TWAP. We're above the 200 SMA. So what does this indicate from a technical perspective the clear support on the bottom of the guppies, which if you zoom out to the monthly exactly is the 50 SMA on the monthly, 10 SMA down here in green. So the bottom of the guppies on the weekly is the 50 SMA on the monthly, pushing back above the 200 SMA with resistance because there is a wick at the top under the TWAB. So what you have is a compression, and you have two price points. Basically, upper 26,000s is a contentious region, and it's chop and it's horizontal until you have enough pressure to push it through one of the resistance levels, either resistance to the upside or resistance to the downside. And overall liquidity conditions in the overall system could significantly influences that directionality. Paul, thumbnails are absolutely hilarious lately. This is a good one. I'm not going to lie, this is a good one. Yeah, they've been pretty good lately. Just something fun. We poke fun at the regulators. Who are they protecting? Do people like myself don't necessarily need their protection, but I obviously appreciate that a lot of people do need protection. How many people sent the Benz? Just sent them money, just sent it to an Ethereum address. That's fucking nuts. That's by definition a capital raise. That's an investment. Where's the contract? Where's the disclosures? Where's the reporting? That's a capital raise. And these other systems that, to a degree, are more sophisticated. Maybe they have that intent to achieve a capital raise, wrapped in a more complex a package, but there are many systems that are not consistent with a traditional capital raise where disclosures are relevant, where protection is necessary, and individuals in any case really should retain the right to allocate capital wherever they feel it is appropriate for them financially. And this comes back to trust, and do we trust the general public to be responsible for their own well-being? And that's really a hallmark of a stable, healthy society where individuals have the education and can acquire the experience to adequately protect themselves and express their own financial interest wherever they see it being most reasonable from a risk-adjusted perspective. Now, bear in mind, risk-adjusted. Do people have a capacity to assess risk? We just saw with the Ben coins that people have almost no capacity to assess risk. We see with the meme coins, with the Pepes and the Doges, that a big cohort of society has literally zero capacity to manage risk. And there's a lot of tragedies financially, so I don't have the answers. I do know my perspective and my capacity to manage risk and to construct a portfolio and express my financial interests and align with different systems and so on and so forth. But obviously, the way I think is not necessarily the way everyone thinks. And the extent of what I can do is share these ideas and hope folks have an increasing capacity to make these rational choices, better decisions, be more reasonable, and be more risk considerate. So we do the best we can. Any other charts? Let's see where Ethereum is. 1840. That's nice to see. It's just horizontal chop. Look at the last 3 months. It's just pure, literally, it's pure horizontal chop and then it's above the average price region where we had chop for many months before. Look at we'll zoom in here. So look at this price region: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months, and we're basically at the top of that level. So if this was an ascending triangle, I would say there's pressure towards the upside, and if you keep hammering the upside enough, you eventually get a breach to the upside. If you zoom in a little bit, maybe we get that kind of, nope, it's just pure horizontal chop. Maybe you do have a little bit of an ascending triangle. Look at me breaking out technicals on the daily. What is becoming of me? I mean, I guess that's how we all started. I mean, that's clearly higher lows. And I mean, generally speaking, horizontal line, generally speaking, there's your triangle. Generally speaking. Well, we'll see. Maybe this pushes down. Maybe there's your trend. But it is higher lows, and that puts us out. Let's go back to the monthly. That puts us out months. If this pattern that we're able to better express on the candles of a daily chart plays out, we're talking 1, 2, 3, 4, end of summer, Q4 2023, potential conclusion to this higher low and a relative ceiling type of structure. But bear in mind, this is a bit of a flag. It's coming off a significant downtrend. This is why it all comes back to liquidity conditions. There has to be adequate liquidity, available currency units on the sidelines to be able to push it up through these regions of price resistance. Last couple of questions. We'll wrap it up for today. Raul's in the house. $1 million. Atom dip is too good to resist, and I decided to sell my ETH and bought Atom. When Cosmos season, when Lambo. No, you have any thoughts on Cosmos? Well, Cosmos, generally speaking, I don't think I have. I'm gonna have to get a new system. I need more video memory. Can we do this? Uh, I need my tabs. Oh, and there goes the memory. Let's see if my computer can hang on. Let's look at overall liquidity conditions. Here's the problem with Cosmos. I have generally a high opinion of Cosmos. I have no interest in exploring the network with regard to an opportunity perspective. I just have an ancient Cosmos position that has been growing and compounding for all these years. So I have quite an interest in that regard. I was relatively early to the system. But I don't think there's much short-term opportunity. Why? What's the stablecoin situation look like? Kava, about 103 mil. Where else is there more stablecoins on Cosmos? And we measure really the potential for a network in terms of liquidity conditions. And obviously, it's Cosmos chains, they're hubs, so there's going to be a lot of chains. We still have the China narrative in play, and that's meaningful, but the liquidity conditions are nowhere exciting or interesting as compared to the sticky capital that has presented itself on Ethereum mainnet. So that's interesting. I mean, obviously, it's out on the risk curve to swap from an Ethereum to a Cosmos or an Atom type of position, but and there's a risk profile associated with that. I wouldn't necessarily do something like that, but I'm in a very risk-off type of position. I'm not too interested in exposing to risk. There comes a point in portfolio structure where you're willing to sacrifice potential upside for comfort with unknowns and uncertainty. And that's where I am. I don't need 10,000x on the money, and I think that's a relatively greedy number. And I'm quite. I think 10x is extraordinary, albeit in 2021 we had a healthy quantity of 10x's in equity land. So, crypto 10x, 100x on certain protocols, and that's not unheard of. And it's quite not unreasonable in many regards, considering the amount of liquidity that's on the damn market. This is a $70 billion market, and now it's down to 68 with a 1.2 drop in liquidity on the weekly. In a world that has how many countless trillions of dollars of dollar liabilities? And then that is significant, and this is the primary market. And you'll have concentrated periods of opportunity. We saw a concentrated period of opportunity in Arbitrum most recently with their token launch. Let's see how optimism is doing. Positive 2.17 on the weekly, but it's a $620 million market. Grand scheme of things, even relative to Ethereum, this market has zero liquidity. It's just you could get opportunity, and that's a process called concentration of capital, where lesser successful projects are underperforming and more successful projects are outperforming, and the capital inherently concentrates from underperformance to outperformance. But when you really have the most opportunity is basically in a positive sum environment. And obviously, this is marginally positive sum for the week, but a positive sum environment would be optimism going from 600 to 1.2 to 2 billion to 5 billion to 10 billion dollars, and we're just not seeing that occur. Obviously, it's relatively flat to say the least. Even Ethereum mainnet is flat. It just means you're going to see only capital being gained, capital gains, in the process of concentration. It's a negative sum environment, and as that capital concentrates and as gains are made, that capital is exported to increasingly safe places, either to stable coins or off the network. And that's the type of risk environment we're in. Risky Cryptos in the house, a pleasure. No horns, no tail, Arnold. Get the chopper. That's a different movie. I'll do some memes on that movie too, inevitably. All right, be careful. The regulators are regulating this global market, and they're regulating only the U.S. arm of it, so I don't really know what the significance is. Obviously, they're thinking relative to an enterprise type of perspective, and they have pushed potential legislation or potential policies for AMMs, which are deterministic smart contracts, which are immutable in most cases. So when the regulators, the SEC, posted their policy or their paper, they literally talked about like governance attacks and 51% attacks on Ethereum mainnet, and it may cost hundreds of millions of dollars to bring an AMM contract into compliance. It's fanciful. That's quite extraordinary, and short-sighted from a technological perspective, or maybe just short-sighted from anything remotely being reasonable. They literally proposed on a system to bring something into compliance with one country's rules. If I were Britain, I'd probably say, yo, SEC, you can't be attacking systems. You can't be suggesting things like that. And that's just one country. What about 195 total countries that probably don't want US SEC attacking systems because they're going to be affecting systems that aren't theirs? These aren't US systems. These are systems of the world. These are systems that are accessible from Britain, from London, the financial center of the world, the derivatives center of the world, the United Arab Emirates, Singapore. I'm pretty sure all those folks have interest in U.S. government regulators not attacking the software that they are probably likely to want to use in their financial system from a dollar liabilities printing perspective. It's it's a big deal. Lucian's in the house. Appreciate you a million too. 34 people, 19 likes. Hit that thumbs up button. I wish you all a wonderful weekend. Understand, appreciate conditions. Try and stay calm. The path of the liquidity cycle is pretty clear, and there's just structure the portfolio, position size accordingly. Make sure that you got cash flow. Don't at the end of the week when you do your claims, it's income. You can't invest all your money, so be considerate, have a risk profile, be diversified, and probably lean towards being more protective. This game is stored in dollars, and that's probably the most important thing to always remind folks. Friday, June 9th at 12:30, 8 p.m. Thank you all for joining, and tell everyone to subscribe and stop by and say hi. After party on Discord for the most rational community in the entire crypto space. I wish you all a good one. Peace.